Hi everyone! For my Excel final project, I decided to use a personal goal of mine as an example. I have always enjoyed driving and I have been looking to purchase a car for a while, but not just any car. I wanted a sporty German car and I had my eyes set on a used 2011 BMW 335i Coupe. I had driven this car a while back and fell in love with it. I just had to have it. Now let's check out the details and cost of this vehicle. I finally found a good deal and the cost of this car is $16,995 plus the New York state tax and the delivery charge and the delivery fees comes to a total of $19,602. Over here you can see the picture of this beautiful car and I found this deal at cars.com. Now, in order to achieve this goal, I have been thinking of investing my money to cover for the remaining cost of the car, which is only $602. But before I proceed with this presentation, I have created this control report to navigate along the workbook. So from here, I'm going to be able to switch between the worksheets. So as I was mentioning before, I began doing research, and since this is the first time I am investing, I am trying to stay away from risky instruments such as options as well as exotic markets like cryptocurrencies due to the high volatility and complexity. So I figure I stick to the basics such as stocks and certificates of deposits. They both have their benefits and drawbacks. I prefer CDs because they are simple and a lot safer than stocks. Considering that you can lose the full principal value of your investment in the stock market. They basically work like savings account and they're risk-free. Now, let's take a look at the performance of 1-year CDs in the last 8 years. You will notice that in 2010 and 2011, the rates were significantly higher but with a steep decline. This is due to the fact that the US economy was still in its recessionary phase. As such, most investors kept shifting away from the stock markets and into bond, treasury, and CD markets to keep their investments safer, yet earning some yield. So this brought high demand for CDs and led to lower rates because banks knew that investors wanted to keep their investments there. However, you will notice that the CD rates have started going up again because we have been in a very strong bull market for the last few years and a lot of investors have been moving their capital into the stock market. Additionally, the Fed has been raising rates as much as 3 times a year for the last 2 years, driving up the Fed and the prime rate benchmarks higher. So, with low demand for CDs and an increasing rate environment, CDs are definitely the ideal investment for my needs. So, here's the data from the chart that we just saw. Now, I have researched over 20 banks to see who is offering attractive rates with reasonable deposit minimums, and I have narrowed down my list to 4 banks. This chart shows where these banks are offering rates within the 1, 3, 6, and 12-month tenors, and the ones highlighted in green are the highest yielding CDs for their respective tenors. For instance, for the 1-month CDs, the Mount McKinley Bank offers 0.15% for a minimum deposit of $5,000, which is the highest. This is actually not a very common CD. Then for the 3-month CD, the TIAA Bank offers 1.65% with the same minimum deposit. Then for the 6-month CD, the United Texas Bank offer 1.90% at 1,000 minimum deposit, and the Barclays Bank doesn't have the best rate for the 1-year CDs, but it doesn't require any minimum deposit, so for me this is a great option. So I have picked these 4 rates for my analysis. So now we can proceed to the solver problem. Now my plan is to invest $19,000 during a period of 1 year, making sure that the principal and the interest from maturing CDs can give me a cash safety margin of $2,000 per month. I am going to use Excel Solver, which is part of a suite commands called What If Analysis Tools, to find what's the optimal mix of CDs, meaning how many and what kind of CDs I should buy in order to maximize the earned interest, taking into account that I want to keep this safety cash margin of $2,000. Now, for the sake of simplicity in this problem, I am making the assumption that I can only buy for the 3-month CDs at the start of January, April, July, and October. For the 6-month CDs, just in January and July, and for the 1-year CDs, just at the start of January. This first table basically shows the characteristics of the 4 different kinds of CDs from the 4 different banks I researched, with the best available rates in 2018 for each category. I am also planning to make the minimum deposit for each kind of CD, and in the case of the 1-year CDs, I decided to do $1,000. In this chart, I have laid out all the structure of the problem. So I have here the months from January to December, and the variables for these problems will be the number of CDs that I'm gonna buy in each month of the year, which are highlighted in yellow. So for the 1-month CDs, 3-month CDs, 6-month CDs, and 1-year CDs, taking into account that I can just buy them in these specific months. So now we can run the solver and see what solution we can get. So I have previously set my cell objective, my variables, which are right here, and along with the constraints. Now we can click solve. And we have found an answer. So according to Solver, the maximum earned interest I can get with the 4 kind of CDs is $657, which means I can cover the remaining of the cost of the car, and finally I can get the car of my dreams. I have also reported Solver results in this table, so it's easier to read than in these cells. So for example, for the month McKinley Bank, which is the one for the 1-month CDs, I should buy just two 1-month CDs at the rate of 0.15%. I also should buy 7 3-month CDs at the rate of 1.65%. I should buy 3 6-month CDs at 2.15%, and I shouldn't buy any 1-year CDs according to Solver. So to conclude, I believe the Solver Excel tool is very helpful because allow you to make intelligent decisions not just in investments but in any other kind of optimizations problems. Could be production, distribution, capital budgeting, among others. Thank you very much.